My name is Daniel, and my hope is to sometimes teach you how to sell and persuade, but you have to learn that on your own. And other times teach you about maybe tax, but you still have to learn tax on your own. So this is only to supplement your own learning, right?
Yes.
So let's jump right in. I have a coffee I want to drink before it gets cold. The information presented should not be interpreted as accounting, investment, legal, and especially tax advice. Just so you know, legally, as a life insurance agent, we have no requirement to disclose tax implications. We do, but people should talk to someone that's liable for the tax advice they get. So we're going to learn about tax today. I've had some experience paying tax. I've filed my tax for 20 years and I paid a few of those years. Financial education is not an option. What I mean by that is you have to learn about tax. You either learn about tax ahead of time or by filing CRA or something like that. Well, we think people are going to learn about money. They're just going to learn from experience or they're going to learn from actually learning, right? Who here wants to learn tax from experience? By paying it, right? So we want to be very holistic. Today we're talking about taxes. Other times we talk about other things. The wealth formula looks like this. And we're going to go fairly quick pace. If you have any questions and you're on Zoom, you guys see each other on Zoom. But instead of putting your hand up, just unmute and say, hey, can we go back and I'll clarify. But when you're building money, you have to take money with the power of time plus or minus a rate of return, and then inflation and tax comes into play. All wealth works like this. So if I buy a car for $80,000 and I own it for 7 years, do I get a positive or negative rate of return on a car?
Negative.
Negative. True?
Yeah. Yep.
Inflation? Does inflation work on my car too?
Yeah.
And do I get taxed if I sell my car for a profit?
I don't think so.
If you sell it for a profit, you do, but nobody sells a car for a profit.
Yeah.
But we're going to look at this. So we're going to look at what's subtracted from your income. We're going to look at what is, one second, let me bring my mouse. Different structures of earning income, and then how investment products get taxed. And then common tax mistakes. Fairly basic.
Yeah.
You guys have all done this already. So when I'm sitting with a client and I say, how much do they pay you? By the way, I don't ask a client, how much do you make? I ask, how much does the hospital pay you? Because then it's not always enough. So I would kind of blame the hospital a little bit. But you might earn, let's say $2,000, but they only pay you $1,500. Because they pay provincial tax, federal tax, retirement, employee, CPP, and other things. So you have a graduated tax system. Basics, this is so you could go do further study. But your first $15,000, no tax. Then your next $15,000 you make interest is 15%. And different ways you earn money is different amounts of tax. So income is the worst. I think income is the worst for every column no matter what. But if you make $250,000, 50% tax. Right?
Can you take a picture?
I could give you all the slides.
Okay.
Does that help?
Yes.
When you do take a picture, what do you do with those pictures?
I copy it in if I have time.
Okay. So, CPP comes off your check. Your employer and employee contribute to CPP. Mm-hmm. If you're self-employed, you pay both. So on one side, you pay less tax as an employee, as a self-employed, but you pay more CPP. The maximum monthly benefit at age 65 is $13.64. or 16,000 a year. So here, your maximum earnings is 68,000, which means your 68,000 you pay tax on, you pay CPP on that, but above that you don't pay CPP on it. It's not insurable. Your first 3,500 you don't pay any CPP on, but here you can see you pay 3,800 a year into CPP if you make 68,000. If you're self-employed, you pay $7,735 a year in CPP if you make over 70,000 a year. So it's 10% of your income goes to CPP. That make sense?
Yeah.
And then employment insurance. So if someone isn't eligible to claim, they can opt out of premiums. So premiums is about employee pays 1%, but the employer pays 2%. And once you've paid in $1,000, you can stop paying. Does that make sense? Mm-hmm. So right away you say, okay, 10% to CPP. Self-employed doesn't have to pay this, but if you're an employee, you pay 2% always to this. This goes to cover pregnant women, maternity leave, unemployment, stuff like that. And then group retirement programs come off your check. So many group retirement programs are RSP Lira. In WFG, do we sell group retirement programs?
So what?
Can we sell group RRSP?
I think so, right?
Yeah. Can we do defined benefit pension plan?
Mm-hmm.
Yes, we can. Can we do group TFSA? Yes, we can. And so I've done some where going to a church, 1 or 2 employees, and I say, why don't you do TFSA instead of RSP? Because in a church, they get a $10,000 a year clergy parsonage tax credit if they don't live at church. But the day they become retired, they lose that $10,000 clergy parsonage tax credit. So we do TFSA instead of RSP. So this shows a chart that what's going to be included. If you get a Lira, your money has to come out of the Lira when you're older. So at age 70, you have to pull out 5%, or 71, 5.2, all the way through. So you have to pull out income later. And is income tax the best rate or the worst rate? Worst rate, right? The highest rate. So, this is an example of your pay stub at CRA. This is a CRA website screenshot. If someone brings home $2,000, their actual take-home pay is $1,500 a month, $1,591. Because if they make $2,000, 26 times a year, they might get $80 vacation pay. So their total pay is $2,080, right? Federal tax, provincial tax, total tax, CPP, EI, total deductions, $488. So almost a quarter is getting deducted.
Plus if you have dental and stuff like that.
Plus dental, plus benefits, but yeah. So you think, okay, here's an example of if I buy an RRSP. So I just added here a $200 group RRSP that comes off this guy's check. So now instead of getting taxed on $2,800 or $2,080, we're deducting $200, and his take-home pay is $1,446. So his take-home pay is about $100 less, but he's saving $200 because he saves the tax. So the question about RRSP is, if I do an RRSP, how do I get the money out of an RRSP? Because I get an RRSP deduction if I invest for my future, but I get the exact same deduction if I buy skills for my future. So if I buy a book like this for $10, it's a $10 deduction, the same as an RRSP. If I go to convention and it costs $200, a $200 convention ticket is the same deduction as an RRSP. If I buy a sales course, I can deduct that from my income, because I'm investing in my future. If I get a WFG code, I can deduct it from my income. If I use gas to come to the office, I can deduct it from my income. Same as an RSP. And then when I make more money later, of course the government's going to tax more money later. So any questions about a paycheck? Is that true? I look back at the Zoomers. Any questions about a paycheck? We're good? Welcome here, Karina and Gina.
All good.
If there is, let me know. Now, different structures of earning. You get to choose how you want to earn money. And I've earned money almost all of these. Employment, sole proprietor, which is another nice word for self-employed, or corporation. So they're all taxed differently. But income is the highest tax. And which one of these always earns income?
Corporation.
Employment. These guys earn profit. These guys earn payments, typically. These guys earn income. What's better, profit or wages?
Profit.
Profit? Has anyone got rich off wages?
Well, you have lots of income.
I read a book about Disney had someone about someone getting rich off wages, but I never met anybody. So profit is better than wages. But it's more difficult than wages. So, employment. Here's the basics. Employees. Let me go back. Employees have little control over their taxable income. Almost everything you get paid as an employee is taxable. Except for travel and food. So if you're a truck driver, sometimes they pay you food cost, stuff like that. Taxes are usually deductible at the source before you even get a paycheck. So you don't even pay your tax, you have your employer pay for you, correct? Now you want to focus on tax deductions, tax credits, and then maybe investment tax planning, because there's not a lot of investment tax planning as an employee. Unless you have a business that you can deduct sole proprietor business or corporate business from your income. So you can mix them. Where's my text? Text is good. Sole proprietor means self-employed. Is wages better than profit? Or is profit better than wages? What do you think? Profit better than wages?
Well,
Yeah,
for me,
profits,
profit.
Profit's better than wages.
Yeah.
So here, you can declare sole proprietorship with no government registration and no paperwork. You just say, I'm a sole proprietor, I'm trying to sell books. So if I try to sell a book, I'm a sole proprietor. Self-employment is a common form of sole proprietor, but being an independent contractor is also, we're independent contractors. You pay tax on income after you deduct your expenses. So I get to earn, let's say my profit is $10,000, but my expenses are $2,000. Then I only pay tax on $8,000. Right? So you can claim income as both an employee and a sole proprietor. So here's how this looks. If I make $3,000 at my job, but as a sole proprietor I earn $1,000, but I spent $3,000 because I went to a convention and I went to a super trip and I bought lots of study material. So now I have negative $2,000 as my sole proprietor, positive $2,000 in my job, my income is zero. Losses can be used against employment for a reasonable amount of time. I believe CRA thinks 3 years is reasonable. If you're losing money for decades, you're not in business. So here's an example of an employee who have $12,000 of expenses during their first year setting up a business. Most expenses you already have. So if someone joins WFG, and this is a single mom, one child, and she earns incoming revenue, taxation, oh, let's go, and then you spend what's left. So you make money and get taxed if you're doing wages. But if you do profits, you have incoming revenue, you spend to earn more money, then you get taxed on what's left, and you have lower taxable income. This isn't a loophole. This is how tax works. You with me?
Yeah.
So here, this is an actual situation, actual numbers as of last year. Someone makes $40,000 a year. Federal tax, provincial tax, CPP, and EI, we deduct those from their income, so they don't take home $3,300 a month. They take home $2,300 a month. So they lose $1,000 a month. Now, they have child tax benefit of $541 a month. That's true, correct? A lot of people have child tax benefit. And they pay debt of $500. So now their bills and their lifestyle is $2,353. Normal human being, correct? Their financial foundation, financial planning, no money to save. Could you find me people that look like this? So now, when they spend money to start a business like this, a lot of people already own a laptop. So they just deduct the cost of the laptop. If it's $500, you deduct that from your income. You import it into your business. If you own a book, you import the book into your business. If you own a camera, you put it in your business. If you own a desk, you put it in your business. If you have a cell phone bill, $100 a month, it's a business cell phone bill, negative $100 a month. That make sense? So now here, business tax deductions, it's not new expenses for most times. Federal tax, provincial tax, CPP, and EI. Now your take home is $2,707. So a lot of people worry about getting into business because of the expenses. But it's the taxes that actually makes a difference. So this person takes home $400 more. So $400 a month more in tax, in less in taxes. Now, they're going to get, instead of $541 in child tax, they're going to get $583. Why do you get more child tax? Less income, right?
Oh, yeah,
Because you're getting $12,000 less income. Because you can deduct business costs against your income. Now, your bills and your lifestyle, same thing, $2,353, $2,353. This person has debt of $500 a month. This person paid that extra $400 and got out of debt. Is that what happens? So now, their financial foundation is $937 a month extra that they could save, buy life insurance, buy savings, pay off their mortgage, give to their kids, give to their church. So if someone has a small business, it's likely $1,000 a month difference just in taxes. Is that a good deal?
Yes.
Any questions about this? Any questions on Zoom? That make sense? By the way, we are set up as a company to help people get into this situation as an independent contractor. So, moving on to a corporation. If someone's incorporated, your net active income, not paid out to shareholders, is 9%. 9. So, if I'm incorporated and I make $100,000, but I live on 50, I pay 50 out and then 50 stays in the corporation, that's taxed at 9%. Is 9% better than income tax? So if you were on a check for $3,000, your tax is only $270. True? So companies pay less tax. But passive investments inside a corporation are taxed at 50. What that means is this. If a Canadian controlled private corporation, we call it a corp, holding corp, operating corp, earns more than 50,000 in passive income, they start losing their small business status. So, common business deductions when you're looking at a corporation or personal, whether it's a phone, fuel, car washes, all this stuff can be deducted, corporate or personal. But when I look at the corporation, if you have less than $500,000 in earning, you get a 9% tax. That's a big deal, correct? So the question is, as a financial planner, if I have a guy who's got money, let's say he earns $100,000 a year profit, what's tax on $100,000 a year?
9%.
$9,000, right? If he leaves it in the company, when he pulls it out, he's got to pay income tax. The tax filing requirements are stricter, but I think a lot of people, if they have profit, they should incorporate. So, one of the things we do with corporations is that money that stays in the corporation, if you use a mutual fund or a GIC at a bank and it earns money, let's say a bank earns, you invest $100,000 in a GIC at 3%, so you earn $3,000 in interest. $3,000 in interest is taxed at 50%. So it's $1,500 in tax. But if you put that money into a growth mutual fund that doesn't sell anything, or a life insurance contract, there's no tax. Because life insurance in a corporation grows tax-free. So it works out very well. Here's some language. Tax credit versus tax deduction. A tax credit is a dollar for dollar reduction in income taxes. So if I owe $10,000 in taxes and I get a $1,000 tax credit, I now owe $1,000 less. A tax deduction reduces your taxable income that tax is paid on. For example, if you start a business and it costs $700, then you get to deduct $700 from your taxable income. But you do get a federal tax credit for your HLQP. So for the $200 HLQP you buy, you get a $100 federal tax credit. So it repays that.
Because of Canada training credits.
Yeah, Canada training credits, it qualifies for that.
But it's just new. That's Canada training. That's not. When I got my LQP, there's no Canada training credit.
Yeah, not no more.
Yeah, no.
But if you're on Zoom, the government will pay your costs.
Yeah.
So, should I incorporate? If you have a profitable business, there's more tax control. But if you're not profitable, there's stricter tax reporting requirements. So, if you're not profitable, there's no real benefit. And if all the revenue is drawn out in income, there's no retained earnings to receive a lower rate. So a lot of times I walk clients through should they incorporate or not. If they're profitable and they're retaining $20,000, $30,000 a year, they should. Leave it in the corporation. And then, how is life insurance taxed? If I have an investment that grows at 10% and I sell the investment, half of that goes to tax. That makes sense? But if I pass away and there's death benefit, the beneficiary is the corporation. The death benefit minus what you put in is taxable. So for example, let's say I have a $3 million life insurance contract, which I do, and my premium I think is about $175. So if I pay that for 2 years, $2,000 a year for 2 years, my wife would get $3 million, my corporation would get $3 million, all tax-free. But when my wife pulls out the $3 million, all but $4,000 would be tax-free. So my ACV is typically what I put into the policy. That is taxable later, which is very small usually compared to the benefit. The amount above the ACB is credited to what's called a CDA account, and it can be distributed to the shareholders tax-free. So if I have, let's say, $200,000 in my corporation, If I take that money out, it's income tax. But if I die and I put it into a policy, it's tax-free. So if I want that money to go to my wife or kids, usually a corporate whole life is best. If the beneficiary is a shareholder, so this is a sticky situation. I love insurance, I'm an advocate for life insurance, but if the beneficiary is a shareholder, the death benefit would go straight to the shareholder. CRA would deem that a taxable benefit to the shareholder and tax it as income. And they may deem the premium tax paid by the corporation a shareholder benefit and tax previously paid premiums. So if you own a corporation who owns life insurance, who should be the beneficiary of the life insurance? The corporation. And then I would have, my will says my wife gets my corporation, with all the life insurance money with it. In the corporate policy, the corp should be the beneficiary. Make sense? So we got employment, very little tax control, but you can be employed and self-employed. Sole proprietor, easy to start. It allows deductions against revenue. And a Canadian, we call it a Canadian controlled private corporation. Just a corporation if you're not a accountant. Lower tax rate, stricter reporting, but it's cost to open and close. That 9% tax rate is so good. 50% tax rate is like double, right? So, where are we at? What's subtracted from Canadian income? You pay deductions from your paycheck, correct? You've experienced that?
No, yeah.
If you're online, you've experienced tax deductions? I see that. I see them here, but I see them here too. Different structures of earning income. If I'm going to work my whole life, what do you think the best structure would be? Let me ask you a better question. If I'm going to work my whole life, if you're on home, you can put it in the chat, I'll see it. What's the worst structure to earn income, tax-wise? Employee. They pay the most. Unless you're a big earner, employees pay the most. But if I make 100K and you make 100K, I'll pay probably 10% tax, 10 grand, and you'll pay 30 or 40% tax. So, some of the questions of where do we put our money? If I put it in 3 buckets, either it gets taxed as it earns, all money is either taxed as it earns, taxed when it's pulled out, or not taxed. So all money falls into these 3 buckets. If you're going to throw money in the garbage, when do you want to throw your money in the garbage? Never. True?
Yeah.
So, things like checking account, savings account, why are those never taxed? There's a $300 threshold. I've never earned $300 in interest on my savings account. Because I don't think I earn interest on my savings account. I pay a monthly fee on this thing. GIC, stocks, mutual funds, it's taxed as it's earned. Tax later is RRSP, and then tax advantage is TFSA, life insurance, your principal residence, FHSA, and insurance. So let's go through these real quickly, help people better understand them. RRSP, when you put money in, it's tax deductible, no tax as it grows, but both the investment earnings and your contribution get taxed when you pull money out. Do you have any questions about RRSP? Make sense? If you own an RRSP, you typically lose your GIS later because your income from RRSP kills your GIS. Tax-free savings, you never pay tax when you pull money out. So I like this. It's one of the 3 pillars, I think, of a rock-solid financial foundation, which is a full TFSA, a paid-off life insurance policy, and a paid-off home. Because a paid off home, life insurance, and a TFSA, there's no tax in the future. You're like away from the government. If you take money out, you can recontribute the following year, and you got about 100,000 of room as of this year. This should be updated. 2025, I think, is $7,000, so you have about 102,000 of room. FHSA, it's the best of both. You can put money in tax-free, and you can pull it out. So you put it in with a tax deduction, and you can pull it out with no tax if you use it to buy a home. So it's for non-homeowners. There's $8,000 limit, and if someone doesn't own a home, this is a great place. And you can also roll over your RRSP to an FHSA, and then pull it out and get RRSPs out without paying tax. And then an RDSP, how is this taxed? So what an RDSP is you put money in, you get up to 3 times your money. This is for anyone who has a disability. So living with a disability, could be an insulin pump, learning disability, blind, deaf.
How about autism? If I got kids with
The doctor has to give them a disability tax credit. Then they get this.
Okay.
You get $1,000 a year in government bonds, and they just pay that to you. You get to invest it, and you get to interest how you want. So the RDSP, when you're looking at how this stuff is pulled out, the deposits are come out tax-free, but the grant, the bond, and the interest get taxed. So your payment is a mix, but it is taxed in the future. And then RESP, this is a funny one, where the deposits are withdrawn tax-free, but the interest in the grant gets taxed. But the interest in the grant gets taxed in whose name?
Child.
The child's name. So do I want my children to get taxed? So usually they get a tuition tax rebate, where they pay $5,000 in tuition, tax rebate, $5,000 in income. But a lot of times what we do is, I just did it where a client had about $100,000 in RESP. We pulled out 50, tax-free, because it was just what they deposited, and moved it to TFSA. And then we're gonna leave the rest grow and pull it out later in the kid's name, before they go back to work. The future tax rate on the gains may negate the benefits of the 20% grant. So here's what happens. Let's say I put in $1,000. I get 20%, so I get $200, right? Now what happens is, I wonder if I write on this. Will this work? Maybe this will work. Let me test that one. So if I put in $1,000, I get $200 in grant. So now what I'm investing is $1,200. And over 18 years, if I double it 2 times, it'll go to $2,400 to $4,800. Right? So now I get $4,800. Right? If I pull this out, I will get taxed on $3,800. So what is tax on $3,800? Is it more than $200 or less than $200? So sometimes that grant might not serve me. It might cause me to pay more tax later. It depends on your income. Sometimes if I use other vehicles, I can get more child tax credit. And then taxation on life insurance. Almost nobody who sells life insurance knows how life insurance is taxed. Would you believe that? It's taught to get you needed to get a license. So everyone has to learn it to get a license. But so if you withdraw cash from a permanent life insurance policy, the growth in the policy is allocated to the withdrawal on a pro rata basis. No one knows what pro rata means because in high school it's not used. What it means is it's the same percentage as the growth. So let's say my policy is my ACB is tax-free. On the bottom is ACB is tax-free. So that's typically what I put in. So let's minus the cost of insurance. So let's say I put in $10,000 and it grows to $20,000. So it's 50-50 because half of it is ACB, half of it is growth. So if I pull out $1,000, half of that is going to be taxed as income, half of it's going to be not taxed. So it's the same allocation as my growth. Make sense? That's why we recommend never withdraw, because you get taxed. A surrender. Surrender means you cancel your policy. If there's growth, it's taxed as income. So to avoid income tax, you have to keep the policy in force until you die. Some policies that's difficult to do because the cost of insurance goes up so high, you might cancel in your 80s or 90s and trigger tax. So that's why when we do permanent, my preference is to do level cost or paid up cost, so they don't have an increase in cost in the future. Policy loan. A policy loan, where there's some growth if it exceeds the ACB, the loan is considered taxable as income. And only the amount that exceeds the ACB is taxed as income. So if the ACB or what you put in is $10,000 and you take a $9,000 loan out, no tax. Policy loans repaid would generate a tax deduction because you're rebuilding the ACB. And then a collateral loan. A collateral loan is tax-free. If a borrower is the owner of the policy, it's tax-free. It may require underwriting and have stricter limits than a policy loan. A loan you can get in one day, but collateral loans, typically they work very well on a whole life policy, but I don't know how to do them on a universal life policy. I don't know a lender that will do one. I just talked to BMO and they said they don't have a UL lending program, but their private banking program has a $5 million minimum. So none of my clients could get that one. So depending how you get it out, collateral loans are the most efficient because they're tax-free. So a lot of times you just say, don't worry, we'll deal with it later. And a collateral loan, the minimum at Equibank is $15,000. So you can do a line of credit for $15,000 if you have $16,000 in your policy, because you need 90%. Any questions? We're good. Let me just check the text. We're good. So, non-registered investments. You ready? Pardon?
What kind of, what are
Non-RRSPs.
Non-RRSP, okay.
So, non-TFSA, non-RRSP, not LIRA, not life insurance. Investment gains are taxed as they're earned. Interest income is 100% income. Capital gains is 50% if it's less than $250,000. Dividends. This is the most confusing thing I ever had to figure out, but now we know how it works. Dividends are preferred rate if from a Canadian corporation, but non-Canadian is non-preferred rate. So what happens is you have an inclusion rate of 138% is added to your income, and then a tax credit of 15% is refunded to you. What does that even mean? If I make $1,000 in dividend payment, I could pay myself a dividend from my corp, or I earn it from a Canadian company. How much of that $1,000 is included on my taxes?
Times 138%.
138. So I would claim on my taxes 1,380. The reason is a corporation earned 1,380, paid taxes, and then gives me 1,000. So what I do is I include 1,380 on my tax return, but then I get a refund of 15%. So if my tax rate is less than 15%, I don't pay tax on that. But if my tax rate is more than 15%, I pay the difference. because the corporation already paid Canadian taxes. And return of capital, we call it ROC, R-O-C, no tax, no tax. So how it's earned depends how it's taxed. Are you ready to go through that a little deeper? See an example?
Sure, I like those examples.
So, by the way, open money comes from a breakdown of a marriage when someone sells a house or refinances. Let's say you guys separate, then you have to take half her house. Then she gives you a check, and now we usually invest that in non-registered investments. If there's a life insurance benefit, if you become a widower, her life insurance might go to you. Usually that's non-registered investments because it's more money than a TFSA limit. So if a client has 100, 200, 300, 400, 500,000, we have to discuss taxes on their investments because we're an advisor, or you bring someone that can. So if you earn $1,000 in interest, how much do you keep, Jeanette? 600. If you earn dividend, you keep 793. If it's return of capital, you keep 1,000. And if it's capital gains, you only pay tax on half of it, so of course you pay half the tax. So 4 different sources of cash flow, each paying 1,000, but how much you keep is different. That make sense? So if I'm in a GIC, what does a GIC pay?
It's interesting.
Interest. Let's say I'm in a Canadian dividend fund. Let's say a GIC at 5 or a Canadian dividend fund at 4. Which one's better?
Dividend.
Get dividend at 4. Because if I earn 4, I keep 3.5. But if I earn 5 here, I only keep 2.5. So how someone's investing is very important. Distributions are not dividends. So a distribution is just a payment made from your investment account to your account. So retired people or widows typically want monthly income the same every month. So if you invest and you draw $2,000 a month from your investment, we just pay you $2,000 a month. That's a distribution. It can be made of interest, dividend, capital gains, or return of capital. You get to choose how you mix up what you get paid. And it can be structured to dominate return of capital, almost no tax. That's better. But if you do a GIC, those distributions are 100% income. So if someone's at a bank earning 4%, they're going to keep 2%. But in my world, I could distribute 2 and they keep 2. Excuse me. One more. Maybe not. I think I have to sneeze, but I'm not sure. So a dividend is earned by a fund holding companies that pay dividends. They're only a component of a fund distribution. And they're taxed as they're earned, not as they're distributed. So if you don't pull any money out of a Canadian dividend fund, and the fund earns dividends, you get paid in the year it's earned. So if you have open money and you're not retired, should you own dividends?
I think so.
Do you want to pay tax every year?
No.
No. So you'd own a growth mutual fund that doesn't pay dividends and it's all capital gains. Capital gains are triggered when it's sold, which is when you retire. But let's say you have a retirement account that's $1 million and half of it is growth. So you can't just move it to dividends because you'll pay tax when you move it. So we have to plan ahead on this stuff. Not all income is the same. So here's just 3 examples. A distribution, if it's a return of capital, no tax. Distributions can be consistent. You could just set up, hey, you're going to get $2,500 a month, while the market value of a fund can go up and down. That way you get the same income every month. Capital gains are taxed when realized, so if a fund grows and only the return of capital is withdrawn, there's no tax. But a GIC, wonderful product, except I never sold one or bought one, is taxed every year. 5% growth is taxed at 40%, is the same as 3% distribution that's not taxed. So if someone earns 5 in a mutual fund, or sorry, 5 at a GIC in non-registered, it's the same as 3 in a mutual fund. And it's added to other income. So, as an example, here we have interest income, capital gains income, non-eligible Canadian dividend, and eligible Canadian dividend. You'll notice if someone earns $48,000, $47,000, how much tax do they pay on Canadian dividends? 3%.
5%, yeah.
They pay 3%. 3%. So if someone's income is less than 47,000 and they're going into retirement, they can do all dividends and have no income tax. But if they do GICs, they're going to pay 25% tax. Can you see how when we talk to people that nobody knows this stuff? Their accountant doesn't tell them, their accountant just files it.
Yeah.
The bank doesn't tell them, the bank just invests it. So, that's federal tax on this side here too. That's federal and provincial. So, let's put it together. I got 3 examples before we finish up. $80,000 a year in income, okay? This is a tax calculator. In this example, you earn $30,000 in income, and you have $50,000 in interest from a GIC. We're going to look at a client who has $30,000 part-time job, and they got $1 million death benefit, which they earn 5% GIC. So 50 grand in a GIC, you see it here, 30 grand in income, 50 grand in a GIC. Tax is 18,000, and the taxable income is 80 grand. You with me? 18,000 or 19,000 in income. Let me know, nod when you read it already. You good? So, average tax rate 24, tax is 19,000. Now, if we take dividend income, 30,000 of a job, they still work part-time or full-time, 50,000 in dividends, so 5% dividend paying out, the average tax rate drops to 10%. Tax paid is 10,000, and the taxable income is now 99,000. Why 99? A dividend has a gross up for income and a refund, because you've got to claim the income the corporation earned before they paid the tax that you're getting refunded. You might lose your OAS in that situation because you're over the OAS threshold.
Threshold.
Right. Every situation is a little different. Here's an example. Part-time job, 30 grand. 50 grand in capital gains. So they're selling 50,000 of shares of growth. The average tax rate drops to 19%. But it's 19% of 55,000 because of the 50,000 in capital gains, they're only taxed on half of that, right? Tax paid is $10,000, and you have lower income, so you maintain your OAS, and you're good for your CCB as well. If you're younger and you have a Canada Child benefit, the Canada Child Bribery benefit, they call it, you might get more of that because your income is now 55,000 instead of 80,000 or 99,000. So how things are taxed can affect everything, depending on if you're an investor or employment or sole proprietor or whatever it is. Here, 50,000 in return of capital. Now your income is only 30,000. Tax is only 2,000. Your tax paid is an average 10% of 30,000 though. It's actually closer to 3% of 80,000. But on your taxable income is 30 grand, really good for Canada Child Benefit. So in Canada, we get to choose when we're taxed, as long as we're not an employee only. So, when you look at some of this stuff, if you make money at a job, you will pay tax. If you spend money, you pay GST and all those other STs. Save money, we have to get taxed. And if you pass away, you get taxed. Of course, if you own personal life insurance, there's no tax. And if your corporation owns life insurance, it's very little tax, if any. If you die at old age, there's no tax. So, common mistakes. The law requires you to keep records of transactions to be able to support your income and expense claims. You have to have receipts. You buy a shoebox at Dollarama, and then you file a claim and you have all your receipts. CRA will not accept bank or credit card statement to justify deductibles. You can go to a liaison for CRA and you can get an interview with them. It's confidential and you can ask them anything you want. So I asked them, so let's say I got robbed and I lose all my receipts. Well, when you file your taxes, you cannot file those receipts. If your house burns down, or they expect you to have your receipts in 2 or 3 places, copy them, and keep some at the office, some at home, some at a friend's house. You're responsible for those. So I said, okay. What happens if you don't file a return?
That's really nice.
If you owe money and you file late, you have to pay 5% up front and 1% a month. So if I have a credit card debt of $10,000 at 20%, should I pay my taxes or my credit card?
Thanks.
Credit card. But a credit card company cannot put me in prison.
But you're gonna get.
But CRA can put me in prison.
Yeah.
So a few months late, or depending on that situation. For example, if I owe $8,000 and I file late, I pay $400 late filing one day late, $400, and it's $1 per month, 1% per month for a year. So if I file a year late and I owe $8,000, they're going to charge me $9,360. So it's not like unlimited fees. It's not like, it's like credit card fees. It's not unlimited, but it's not free. So if someone's, this depends on the situation, but you should know what you're paying if you file late. The tax planning is not just for the wealthy. Knowing how tax works, tax season is coming soon. Maybe begin to work as a sole proprietor to have tax efficient income. Or if I earn, for example, 6% tax free, or I'm in another investment that I earn 8% taxable, the 6% is actually better because it's totally tax free. Track and increase your investments into your income, which means invest in knowledge, invest in books, invest in courses, invest in skills, invest in licenses, designations, offices, technology. Plan your current taxes, next year's taxes, and maybe tax into the future. I don't own any RRSP, any LIRA, any deferred tax instruments. I don't own any of them. I worry the tax rate might go up. And then I don't want to be sunk. I never stop learning about anything that has a large effect on you, that tax always changes. You learn something, you think, oh, that makes sense. But this guy quoted, I see so many waste money by overpaying in taxes. If someone makes $100,000 a year, I think we could sit down and we could probably save them $10,000 a year in taxes. And that's the money they could save for their future and protect their family and get their financial foundation in order.